Today, we are reviewing one of the most well-known indicators on TradingView, Squeeze Momentum Indicator. This indicator was created by LazyBear, and the TradingView page lists it as an open-source script, originally published on July 4, 2014. It is a free, open-source TradingView indicator that anyone can inspect, which already makes it an ideal candidate for a proper audit. The indicator itself is based on John Carter's TTM Squeeze, which comes from his trading work and is discussed in the book Mastering the Trade. The author clearly states that this script is a derivative of Carter's TTM Squeeze concept. Now, before we review LazyBear's version, we need to understand the original idea behind the TTM Squeeze. The TTM Squeeze is basically a volatility compression and momentum indicator. The core idea is simple. Markets often move between periods of contraction and expansion. Sometimes price becomes quiet, compressed, and range-bound. Then, after that quiet period, volatility expands, and the market makes a stronger move. The TTM Squeeze tries to visually identify that compression phase before the expansion happens. The way it does this is by comparing Bollinger Bands and Keltner channels.
The squeeze happens when the Bollinger Bands contract so much that they move inside the Keltner channels. That is the indicator saying volatility is low, price is compressed, and the market may be preparing for a larger move. When the Bollinger Bands expand back outside the Keltner channels, the squeeze is considered to have fired, meaning volatility is expanding again. This is important because the squeeze itself does not magically predict direction. It mainly tells us that volatility has compressed and may be transitioning into expansion. The direction is then interpreted using the momentum histogram. That is a key distinction. A squeeze is not automatically bullish or bearish. It is more like saying something may be building here, but we still need direction and context. On LazyBear's TradingView version, the squeeze state is shown using crosses on the midline. According to the original notes, black crosses show that the market has entered a squeeze, meaning the Bollinger Bands are inside the Keltner channels. Gray crosses show the squeeze release. LazyBear also explains that Carter's suggested approach is to wait for the first gray cross after a black cross, then take a position in the direction of momentum. For example, if momentum is above zero, the idea would be to look long. If momentum is below zero, the idea would be to look short.
But LazyBear's version is not a perfect clone of Carter's original TTM Squeeze. This is one of the more important details. LazyBear notes that Carter used a simple momentum indicator, while LazyBear used a linear regression-based method to plot the histogram. So when people say this is the TTM Squeeze, that is only partly true. The volatility compression logic is based on the TTM Squeeze idea, but the histogram calculation is LazyBear's own interpretation. As for market and time frame, the page does not clearly say that it is designed for one specific asset class or one specific time frame. It appears to be a general-purpose technical indicator that traders apply across stocks, forex, crypto, commodities, and indices. The TTM Squeeze concept itself is widely discussed as something traders can apply across different markets and timeframes, but that does not mean it works equally well everywhere. That is something we need to be careful about. A squeeze indicator can look very convincing on historical charts because volatility contractions are easy to identify after the fact. But the real question is not whether squeezes exist. Of course they exist. Markets compress and expand all the time. The real question is whether this indicator gives traders a reliable and practical edge when used live. Even the author's own notes are quite honest here. He says that, from his limited experience, an additional indicator like ADX or wave trend may be needed to avoid missing good entry points. That is a useful comment because it tells us the creator did not present this as a magical standalone system. Before reviewing the code, let's look at the indicator as a user would first see it on TradingView. Visually, the squeeze momentum indicator is clean. It sits in a separate lower panel,
so it does not cover candles or interfere with the main price chart. The main elements are the momentum histogram and the squeeze state crosses on the zero line.
The visual logic is simple. The histogram shows momentum above or below zero. Green bars show positive momentum. Red bars show negative momentum. The shade changes depending on whether momentum is increasing or decreasing. The crosses on the zero line show the squeeze condition. Black crosses indicate squeeze on, and gray crosses indicate squeeze released. That makes the indicator easy to read at a glance. There are no labels, arrows, tables, or excessive visual elements. This is one of its stronger points. It communicates the core idea without clutter. The downside is that the histogram can look very convincing after the move is already visible. Large green waves often appear during established bullish movement, and large red waves often appear during established bearish movement. This creates a strong hindsight effect. The clean waves make past moves look obvious, but live interpretation can still be less clear, especially near the zero line or during choppy market conditions. The squeeze crosses are also visually subtle. The indicator does not visually emphasize the exact moment of release very strongly, so traders may need to pay close attention. The indicator works well with other chart tools because it stays in its own panel. It can be used alongside moving averages, volume, support and resistance, or higher time frame analysis without making the chart unreadable. Overall, the visual first impression is positive. The indicator is clean, readable, and focused. Its main weakness visually is not clutter, but hindsight bias. For decision context, it gives useful momentum and compression information, but the chart still needs outside context.
Now, let's review the code. This is an open-source PineScript indicator. The code is visible, not protected, and not invite-only. The script is old Pine syntax, shown as PineScript v3. It uses study rather than the newer indicator format. The first major check is repainting risk. There is no security or request.security call in this script. That means the indicator is not pulling higher time frame data, lower time frame data, or data from another symbol. That removes one of the biggest repainting red flags. There are also no pivot functions. No pivot high, no pivot low, no zigzag, no future bars, no signal confirmed later and plotted backwards. The functions used here are standard rolling calculations. So historically, there is no obvious future-looking logic in the script. But there is an important code issue. The script defines this input. Mult equals input 2.0, title BB mult factor. But the Bollinger Band deviation is calculated like this. Dev equals mult KC times STDev source length. That means the BB mult factor setting is not actually used. The script uses mult KC for the Bollinger Band deviation instead of using mult. So if a user changes the BB mult factor setting from 2.0 to something else, it should have no effect on the Bollinger Band calculation. That is a real implementation issue. It also means the default Bollinger Band multiplier is effectively 1.5 because mult KC defaults to 1.5, even though the settings show BB mult factor as 2.0. That matters because the squeeze condition depends directly on the width of the Bollinger Bands versus the Keltner channels. If the Bollinger Band multiplier is not being used, the squeeze behavior may not match what the settings suggest. LazyBear mentions this issue on the indicator page and links to an updated version, but the source shown on TradingView still displays the old version. The momentum calculation uses the current bar and previous bars. The LinReg offset is 0, so the value is not shifted into the future. The histogram color is based on whether val is above or below 0, and whether it is rising or falling compared to the previous bar. So the plotted histogram is directly tied to the code. There are no hidden signals. However, the current candle can still change while it is open.
The script uses close, high, low, TR, highest, lowest, SMA, and linreg. All of these can update intrabar, so the current histogram bar and zero-line color can change before candle close. That is not historical repainting, but it does mean live users should treat the current bar as unconfirmed until the candle closes. There are no built-in alerts in the script. No alert condition is defined, so there is no alert logic to compare against the plotted signals. There is also no backtest logic. Chart type matters as well. The script uses the chart's own close, high, low, and TR. It does not force true OHLC data. On normal candles and bars, it uses normal OHLC. On Heikin-Ashi charts, it uses Heikin-Ashi OHLC. So the histogram and squeeze state can change depending on the chart type. The code review conclusion is, the script has no major repainting red flags. It does not use security calls, lookahead, pivots, zigzags, or future bar plotting. But it does have a clear settings issue. The BB mult factor input is unused because the Bollinger Band deviation uses mult KC instead of mult. That is the main technical problem in the code. This indicator is very simple from a settings point of view. There are only 5 inputs, and they all relate to either the Bollinger Band calculation, the Keltner channel calculation, or the range calculation. The first setting is BB length. By default, this is set to 20. This controls the lookback period used for the Bollinger Band moving average and standard deviation calculation. In plain English, it controls how many candles the indicator uses to measure recent price behavior for the Bollinger Bands. A shorter BB length makes the Bollinger Band calculation react faster. A longer BB length makes it smoother and slower. So far, that part works normally. The second setting is BB mult factor. By default, this is shown as 2. Normally, this should control how wide the Bollinger Bands are. A higher multiplier should make the bands wider, and a lower multiplier should make them tighter. But in this script, there is a problem due to the bug in the code we identified in the previous section. That means the BB mult factor setting is effectively unused. That is the main settings issue in this indicator. The third setting is KC length. By default, this is set to 20. This setting controls the lookback period for the Keltner channel calculation. It is used for the Keltner moving average and the average range calculation. But it also does something else. The same KC length is also used inside the momentum histogram calculation. So this setting affects more than just the Keltner channel. It also affects the histogram smoothing and momentum reading. That is important for users to understand. If you change KC length, you are not only changing the squeeze channel, you are also changing the momentum histogram behavior. A shorter KC length will usually make the indicator more sensitive. A longer KC length will usually make it smoother and slower. The fourth setting is KC mult factor. By default, this is set to 1.5. Normally, this should control the width of the Keltner channel. A higher value makes the Keltner channel wider. A lower value makes it tighter. The fifth setting is Use True Range. This controls how the Keltner channel range is calculated. When this is turned on, the script uses True Range. True Range considers the current high and low, but it also accounts for gaps from the previous close. This is usually more complete than just using high minus low. When this setting is turned off, the script uses only high minus low. So with True Range on, the Keltner channel can respond better to gaps and larger volatility changes. With it off, the range calculation is simpler and only looks at the current candle's high-low range. For most normal use, leaving True Range on makes sense. For this review, I am not scoring the original LazyBear script exactly as published. I made a working copy of the script and corrected that line so the Bollinger Bands actually use the BB multiplier. As an indicator, I think it is decent. The histogram is easy to read, the squeeze crosses are simple, and it does not clutter the main chart. Across the markets I checked, crypto, forex, gold, and indices, it generally does a reasonable job of showing momentum phases. But I would not overrate it. The main limitation is that the histogram often confirms a move after momentum is already visible on the chart. It can help you stay aligned with the current swing, but it is not consistently early enough to treat as a strong entry trigger by itself. The squeeze idea is useful, but a squeeze release does not guarantee direction or follow-through. Sometimes the release comes before a good move. Other times it releases into chop, stalls, or confirms too late. So I would evaluate the fixed version as a volatility and momentum context indicator, not as a trading system. Even better, you can take the original squeeze idea and make your own version of the indicator in TradingView that suits the market and style you are most interested in trading. If you found this video useful, leave a like, subscribe to the channel, and let me know in the comments which TradingView indicator you want me to audit next. Also, if you use this indicator yourself, tell me how you use it. Do you trade the squeeze release, use it as confirmation, or only use the histogram for momentum? Thanks for watching, and I'll see you in the next review.